One of the best ways to make money on the stock market is dividend growth investing. Dividends, when reinvested, can result in a phenomenon known as dividend compounding. Compounding produces a snowball effect that allows dividend investors to outpace inflation and build massive wealth over time. Hey everyone, it's Brandon. In this video, I share how the power of compounding can maximize the passive income potential of your dividend growth portfolio. Before we get started, if you find this information helpful, please subscribe to this channel and ring the notification bell to be notified of future uploads. It helps my channel more than you know, and I genuinely appreciate the support. Now let's get started. Okay, welcome back to my portfolio. So as you can see, the day change for today, April 29th, 2022. The market saw a pretty big dip today, mainly due to the technology stocks such as Amazon, who saw post-earning reports and losses of up to 14%. NASDAQ was down 4%, and my portfolio is not going to be any different. S&P was down, Dow Jones was down, all the markets are basically down. My portfolio is down 3.22%, and I'm down about $550 on the day. In this video, I'm going to try to explain why these red days and bear markets and stock market corrections in general are actually a good thing for us dividend investors, and why we look forward to these days and why we look forward to these corrections, because they help us to produce and buy up dividend stocks that give us massive income in the future. And yes, the dividend yields are small now, but as the stock market drops, the yields go up. We're going to buy more stocks and take advantage of those higher yields, and in the future, our portfolios will provide us with a very nice reward called passive income. So let's take a look at why this is the case. Let's start with a fundamental question about dividend growth investing. What are dividend stocks? Dividend stocks are stocks that pay shareholders a distribution of funds as part of the company's earnings. Companies make dividend payments directly to the shareholders' investing account. So what this means is that if you purchase a company like Apple, you would buy their stock, and every quarter they would pay a percentage of their profits with you, the shareholder. The next question we have to ask about the dividend growth process is about dividend compounding and the snowball effect. Dividend compounding occurs when the investor reinvests their dividend payouts over time, allowing them to accumulate more company shares. This strategy creates a snowball effect that gains momentum over time and generates more long-term dividend income exponentially. What this means is that you, as an investor, when you purchase a stock that pays dividends, you buy the stock and the company pays you a dividend as a reward. You take the dividend cash, reinvest, and you purchase even more shares of the company. Because you have more shares of the company, the next time they pay a dividend, you're going to receive more dividend cash in return, reinvesting the dividends, buying more shares, and reinvesting the dividends over and over until eventually you create such momentum that your dividend income grows exponentially and returns more in the future. Now that you know about dividend compounding, let's talk about the dividend yield. What is the dividend yield? The dividend yield is a percentage of a company's share price paid to shareholders annually. To calculate the dividend yield, divide the dividend amount by the current share price. For example, if a company pays a dividend of $2 and the share price was $85, the dividend yield would be 2.35%. So this is going to be true at the time that you purchase a stock, but over time, when a company increases their dividend, and they do increase their dividends, because they will pay you more cash as a dividend payout, and you still have the same amount of money invested in their company, your dividend yield goes up, and we call this metric the dividend yield on cost. What exactly is the dividend yield on cost? The dividend yield on cost is the percentage a company pays its shareholders each year in dividends based on the initial cost of the investment. When a company increases the dividend amount, the yield on cost of the initial investment also increases, creating higher returns over time. So as I mentioned, when the company increases the dividend, your yield on cost goes up, but it does not affect the current dividend yield. If you were to buy the same stock today, that you paid for a stock, let's say 1 year ago, and you invested the same amount of money, because the dividend yield is lower than the dividend yield on cost, your dividend payout will be lower. Okay, now let's look at an actual dividend history growth chart so that you can see exactly what a real life company looks like when they increase their dividends over time. So here I'm going to use the example Johnson & Johnson. And Johnson & Johnson has been increasing their dividend and growing their dividend for 59 years. This is absolutely incredible, and the reason why I wanted to use this particular stock for the visualization. So Johnson & Johnson was paying a dividend of a massive 4 cents, if I can get the pop up here, back in 1989, 4 cents. If you fast forward to present day, they are paying a dividend of $1.13. Now, if you look at this chart, it's pretty consistent. Look how evenly and smoothly they've been increasing their dividends over time, and this is the power of dividend growth investing. If you would have invested way back here, your yield on cost would be much higher if you were still holding the shares today. Okay, now let's look at a dividend calculator that I created in Google Sheets. This calculator will help us visualize what the power of dividend compounding looks like over time. So the important columns here are G, which shows the dividends that our company is paying out each year, and then the yield on cost shows us what our actual yield on cost looks like after 30 years. So let's start with the dividend. You can see that we're going to start out with a dividend of $3.50, and over time, the company is going to increase their dividend, or we expect them to increase their dividend by about 8%. So as they increase their dividend, if you remember, our yield on cost will go up. So when you initially purchase a stock and you're receiving a dividend of 3.5%, your yield on cost will also be 3.5%, but over time your yield on cost will go up, and the yield will be whatever the dividend is in relation to the price of the share. So look at this column here. We've got 3.5%, and we're receiving $560 in income based on a starting investment of about $10,000. Now, with this income, that brings our new portfolio balance to $16,560. But over time, if you look 30 years, look at the yield on cost. 9.92%. That's almost 10%. So for every $100 that you've invested, you're going to receive $10 in income. And this affects our balance of the portfolio. Look at column K. After 30 years, that means that the balance of our portfolio could potentially be almost $1.5 million. This is absolutely incredible. So I like this calculator because I can plug in different numbers and I can really visualize what my own Roth IRA portfolio could look like over time. So if I wanted, I could say, okay, I expect them to increase their dividend by a ridiculous 15% every year. And look what this does. My new balance at the end of 30 years ends up at $10 million. Now, is this likely? Probably not. But that's okay. I just wanted to show you that I can change these inputs over here and I can visualize what the portfolio might look like. Just a few side notes. This calculator is not perfect and could use some adjustments, and it doesn't factor in things like taxes, and it doesn't factor in inflation or anything along those lines. But I just wanted to give you guys kind of a visual to help you see how powerful dividend compounding is and how powerful it could be for your portfolio. Now I want to give you guys a look into my Roth IRA portfolio so that you can see some real life examples of stocks that are paying a dividend yield and how much of a yield on cost I'm receiving every year. We'll look at AbbVie. If you look over at column K, they're paying a dividend of $5.64, which brings their dividend yield to 3.84%. And because I've purchased AbbVie years ago, I'm actually receiving a higher dividend yield because of the dividend increases, I'm paying 5.27%. Now this is amazing, and in the future I'm going to continue to see a higher and higher yield on cost with AbbVie, because this is a company that will continue to increase their dividend over time. Well, that's it for this video. Don't forget to like and subscribe to this channel. Thanks again for watching, and I'll see you next time.